All right, everyone, welcome back. I hope you had a nice lunch break and filled up and got ready for an afternoon of technical analysis. We are very fortunate to have Richard Moglen as a speaker right now. Richard is a YouTuber. He's a co-founder of Trader Lion. He's one of, I think, the go-to resources on technical analysis that you can find through Fintwit and other mediums on the internet. I've learned a lot from him. I've had the benefit of talking to him a lot. Did I think his podcast at one point. So, Richard, thanks so much for being here and welcome to the show.
Yeah, thanks so much for having me. I know how much work goes on behind the scenes to put something like this together. So thank you guys so much for inviting me. And yeah, hopefully I give a good presentation and we challenge some notions. I know most people are probably focused on fundamentals here, but as I was saying to the guys in the green room, I think everybody can benefit from learning at least a little bit of technical analysis. So yeah, am I good to go?
Yes.
Let's do it.
All right. Yep, you can see my laser pointer. Perfect. So here's a little bit of a sneak preview of kind of what I'll cover today. First, a little bit about my background and overall perspective. I think it's always good to kind of hear where a speaker's coming from, how they've learned all of that. Then we'll dive a little bit into technical analysis, talk about the 4 different stages, which should be one of the biggest takeaways from today. Then run through a ton of historical examples, both recent as well as going back a little bit in history. And then I also talk a little bit of buy and sell rules from a technical perspective. And then even if you don't pay attention to any of the first 5 things, I think the IPO primary base setup, which is a technical setup, is something that every investor should be interested in because it's often a fantastic spot to start accumulating, even just dollar cost averaging into some high flying, a lot of potential growth stocks that have come public, consolidated a bit, and now are potentially starting their more mature phase where they can go on some incredible moves. And make sure you're paying attention at least a little bit because I will be giving a short final quiz. So make sure you take some notes. I'm just kidding. You don't have to take notes, but pay attention a little bit and we'll see if you can get that final quiz right. So first, a little bit about my background. I began trading in 2018. I took a class at the University of Maryland called, I believe, the Introduction to the Stock Market and Technical Analysis, taught by my professor, Dr. Eric Wish, who's been trading successfully for over 50 years. I took that class, loved it so much. I was a TA the next 3 semesters, and he wasn't a TA. I was even a TA in grad school as well after I graduated. In 2020, I got my BS in mechanical engineering, worked at the Naval Research Lab in soft robotics for a year and a half or so, and then transitioned over full-time to Trader Lion, trading and all of that. Yeah, Seifel mentioned this a little bit, but I've done interviews with some amazing traders, hedge fund managers, PMs, U.S. investing champions, which are pretty much trading champions. It's not really a focus investing because the time frame is 1 year, but nevertheless, some fantastic traders. I was just kind of thinking today, I've been so lucky to get to learn from all these guys who have been doing it for multiple decades, gone through so many different market cycles, and that's definitely shortened my learning curve a whole bunch. I'm currently working as the director of education and co-founder at Trader Lion, and I'm also the host of the Trader Lion conference. I did that this year as well as last year. So lucky to have hundreds of thousands of views on that live stream. And as I said before, I know how much work goes on behind the scenes of a conference like this. So props to everybody involved here. Some great guests, and yeah, I'm grateful to be a part of it. So first, kind of taking a step back before we dive into technical analysis. What are our overall goals in the market? Basically, we want to develop a system that produces strong returns over time. And what that comes down to is making money over time. Now, it doesn't matter if you're an investor or trader. That overall goal is the same. We just have different time frames. I think some of these labels just kind of cause conflict on Twitter. This investor's arguing about this trader. But the key thing is that they could both be right for their time frame. The short-term downtrend, we could be in a downtrend, but the longer-term trend could be up, and both of them can make money over their timeframes. Now, a key thing is that the system that you develop, whether you're a trader, a position trader, a swing trader, day trader, investor, it has to match your time frame, your lifestyle, and as well as your commitment level. If you're working a 9 to 5 where you can't look at the screens at the open or during the day at all, you're not really going to be able to day trade because you're going to need to look at the charts to be able to do that. So it's important that your overall system matches your lifestyle. I think that's something that can't be said enough. Now, in order to build these systems, Basically, we have to look for setups and edges. Now, a setup doesn't just have to be a technical setup. It could be a macro setup where the Fed is putting in so much QE and spurring the economy and all that in the stock market that way. It could be a fundamental setup where earnings growth is up 100% the last quarter, or it can be a technical setup, which is kind of what I'll talk about and focus on today. And going back to kind of the differences between investing and trading, I think one of the biggest keys is that investors focus first on the kind of company and then kind of look at the market and try to not impose their will, but they're saying that this should be worth X amount, while the traders kind of look at the stock chart first and say, okay, this is what the trend is as of this moment. This is what the market thinks of the stock, and I'm just going to follow that trend. And that's kind of what we'll be talking about a lot today, overall trend following. So goals for today, hopefully we accomplish all of these. First, I'm going to introduce you to some basic chart reading. If you have no experience, you should be covered today. We'll talk about how to determine the stage of a stock, and there's 4 overall stages, which we'll cover. I'm going to try to challenge your thinking, especially if you don't think technical analysis works at all. I'll try to challenge that perspective. And I'll also suggest a few rules based on technical analysis. And as I mentioned before, even if you don't, listen at all to these first 4 parts, we'll go over the IPO primary base setup, which I think is money, and is definitely something that even investors should be focused on. So first, talking about technical analysis, I think a lot of investors think it's kind of like this. You just draw lines all over the place. You have 50 different indicators, and you're magically predicting what a stock is going to do, or at least you think you do. But in reality, that's not what technical analysis is at all. I mean, the most experienced traders who are completely technical focused, who I've talked to and interviewed, they have as little indicators on their screen as possible, as little lines as possible. And really what they're focusing in on is the trend of the stock and also, supply and demand. Can I manage risk in this environment? And is the stock likely under accumulation? So this is kind of how I view technical analysis. So first, our number one goal is to identify trends or consolidation. Is the stock overall in an uptrend? Are we going sideways or are we in a downtrend? There's kind of 3 different possibilities. Then I'm looking to see, can I manage risk using a stop loss under a relevant high or low? I'm not going to get into stop losses at all. I think that's a talk for another conference. But I'm always using technical analysis to manage risk. That's one of the key uses for it. Then, along with these top 2, I'm looking for evidence of either accumulation, where we've got trends above moving averages, gap ups on volume, great closes on a weekly chart. All those different signs in the chart give you little hints about whether a stock is under accumulation overall, or on the converse, on the flip side, if the stock is under declining moving averages, trending down, there's gap downs on volume, bad reactions to earnings. Those are all signs of distribution. So overall, from this presentation, these are kind of what I hope my key takeaways or your key takeaways are. First, that the weekly trend reveals the actions of institutions, accumulation versus distribution. And notice that I'm saying the weekly trend here, because I think for investors with a longer term time frame, trying to hold for multiple years or at least multiple months, the daily action is just a lot of noise. But that weekly trend is extremely important and can help you a lot and increase your probabilities of success in an investment. Then I also want you guys to understand that trends can last a whole lot longer than we can imagine, both to the upside and downside. I think in 2020, we saw so many great examples of amazing trends to the upside. And then this year, unfortunately, we're seeing a lot of those completely round trip, which I'm sure nobody thought was possible. Great stocks like Roku, Shopify, all of those, a lot of those have completely round tripped and given back all their gains. Then basically another number one of my goals today is for you guys to be able to identify these trends and understand that they can complement your existing edges in the market. So if you're very fundamental focused or macro focused, that doesn't mean that technicals can't help you. In fact, I think the best way to do things is to combine as many edges as you have. I personally look at earnings growth, I look at sales growth, but I also combine that with technical analysis to help with my timing and manage my risk. And the key questions you want to ask yourself is, does the market agree with your thesis? Even if, we were talking about AMD earlier in the green room, AMD is a fantastic company, great graphics cards, so much innovation, but right now it's in a downtrend. And for my time frame, that's really all that matters. And even for investors, you might want to consider waiting to starting a position until the market agrees that that company is good, because often, technicals break down before the fundamentals. So it's always important to listen to the price action. Finally, is a stock you're buying under accumulation? This is a big question. And basically, is it in an uptrend or downtrend? So first things first, I kind of want to build a very simple chart layout that you guys can use. And it's not something that, as I said, you have to look at a day-to-day basis. This is a weekly chart. And it might look like a lot of random noise to you if you've never looked at a chart before. But basically, this is a time scale on the bottom. This is price on the right here. And each of these bars represents 1 week's worth of price action. Here we had an open down near around 22, a close on the week around 34, and an increase in volume. That's a very good bar. And very simply, we're just looking at the overall trend. And to do that, we'll basically add one moving average, the 10-week moving average, which is a great kind of midterm, intermediate term moving average. And basically, you can say that over this time period, the intermediate trend is up. We're also going to add a 40-week moving average, which gives us a better sense of the longer term moving average or the longer term trend of the stock. So if you're a more longer term focused investor, you probably want to focus a little bit more on this 40-week moving average and what the stock is doing relative to that. While if you're a position trader or kind of shorter term investor, likes to hold for a few months, you might want to pay more attention to that 10-week moving average. So the 10-week is in blue and that 40-week is in black. And you can see here we're trending below a declining 40-week. This is a chart of, Fastly, which I mentioned earlier. Great move in 2020. And then we've completely round tripped and even undercut these prior lows. So let's talk a little bit about definitions. I've mentioned these terms before: uptrend, downtrend, consolidation. First, an uptrend is simply when price is trending above a rising 10-week moving average, this blue line, as well as that 40-week moving average. That's as simple as it gets. This is a beautiful uptrend. I believe this is Roku back in 2020, an awesome move above those moving averages. On the flip side, a downtrend is simply when price is trending below a declining 10 and 40-week moving average. This, I believe, this is Teladoc during this year. Definitely a very strong downtrend. You can see we also had this gap down on earnings, and we just continue to trend below a declining 10 and 40-week moving average. Then when a stock isn't in an uptrend or isn't in a downtrend, we have a consolidation where basically price action is drifting sideways. We're chopping above and below different moving averages here. We're above and below the 10-week because we haven't had 40 weeks to create this moving average yet. You can see it appears here after 40 weeks. Here we're in a short-term downtrend below a declining 10-week moving average. Here, short-term uptrend. The 40-week appears, and once again, we're chopping above and below the 40-week moving average. And it's important to be able to kind of spot these consolidations, because when a stock breaks out above an important high or an important low, that could be the start of either an uptrend or a downtrend. And that's when we can get involved and start a position. So I've kind of talked about uptrend, downtrend, and consolidation. And I want to kind of take a step back and talk a little bit about the 4 different stages, which basically represent those 3 things. So this is a concept developed by Stan Weinstein, who is the author of Secrets for Profiting in Bull and Bear Markets back in the 1980s. He currently writes Global Trend Alert, which advises institutions. And basically, he developed a system that uses a simple moving average and determines whether a stock is in one of 4 stages. Stage 1 is a consolidation period where price is going above and below the 200-day moving average, which is the equivalent of the 40-week moving average. Then a stage 2 is when we finally break out and begin a longer-term uptrend above a rising 40-week moving average. This is when the majority of gains are made in any stock. Then after that stage 2, we can get a stage 3 where price action gets kind of wider and loose. We undercut that moving average, go above and below it. And basically, this is another consolidation phase where, for the most part, we're drifting sideways. Now, from the stage 3, we can either restart another stage 2 uptrend if the stock breaks out again, goes above a rising 40-week or 200-day moving average, or we can begin a stage 4 downtrend where price undercuts the moving average and starts trending below it for an extended period of time. And this, unfortunately, is when a lot of damage is done to different accounts. We've seen a lot of examples this year from Name a stock, it's probably been in a stage 4 downtrend. Even stocks like Netflix, Facebook, or Meta, or whatever they call it these days, they can all go through stage 4 downtrends, and that's when a lot of damage is done, and that's when years of uptrends can be undone in just a few short months. And after stage 4, eventually the selling pressure will attenuate, and it will restart as stage 1, and ultimately maybe restart as stage 2. So quick quiz. First, what is the stage of this, whatever stock this is? And I'm not sure if I can see the chat here or not, but answer for yourself. What is the stage of the stock? Look at all the way to the right. Where is the stock relative to the moving averages? And are they increasing or decreasing? And yeah, I'm not sure if I can see any responses, but I'll give you just kind of 10 seconds to think about it. What stage is the stock? And also, does anybody know what stock, or hint ETF, this is? So I'll give you just a few more seconds here. Okay, so this is in the stage 4, and this is actually the NASDAQ 100 ETF, the QQQ. We're below a declining 10-week and 40-week moving average. We have been for the majority of this year, and that's why we've been in a bear market. That's why there's been so much damage. I see somebody mentioned ARK pretty close. That's also been in a stage 4 downtrend. But this is the NASDAQ 100, the QQQ. You can see how we were rejected at that 40-week line 2 times, and this is the same on the S&P 500. And right now we're just in a longer-term downtrend, and we'll just have to see whether we can begin a stage 1 and rebuild a potential stage 2 uptrend. So why does all that I've mentioned matter, and how does this help my process? You might be asking yourself. So first, I think it's always important to listen to the market. Even if you think you have found the golden stock, your ticket to riches and private jets, you have to listen to the market and make sure that it agrees with you, because your opinion doesn't matter. As I was mentioning before to Seifel, the market is the ultimate arbiter of whether you're right or you're wrong. And it doesn't matter if you think you're right. If the market doesn't agree with you, you're not going to make money. So in order to improve your consistency, you basically want to align your buys and sells with the market, with that longer term weekly trend. This can also help you find ideas. If you focus on stocks that are just starting stage 2 uptrends, those are stocks that could have really interesting fundamental things going on, that are going through exciting quizzes, all of that. Not exciting quizzes, exciting themes. So I was reading the chat, got distracted here. But basically, it can help you find ideas that are working, and it can help you identify themes in the market. Previously this year, oil stocks were all in stage 2 uptrends, while the market was once again in a bear market. And that helped you identify that theme was working. Recently, we've had the biotech stocks start stage 2 uptrends. Many of those stocks are acting extremely well, even given the overall backdrop. Now, it can also help basically soften drawdowns. So if many of your stocks enter stage 4s, that's a sign to lighten up and just be a little bit more patient. And if you do exit and limit the damage, as we'll go through some examples later on, it can help soften the drawdowns and also preserve any profits that you made in the previous few years. So here's another question that I wanted to ask everybody, and you can answer either in the chat or just to yourself. How many of you have concrete sell rules? So this doesn't have to be technical focus. That's going to be what I talk about, but this could also be a fundamental reason. Growth is slowing, the management leaves. But for me, it's all technical focus, because I believe kind of all the different information gets incorporated into the price action itself. So I'm going to focus on the technicals, but regardless, even if you don't agree with technical analysis at all, don't know how to use it, you should have a reason, and ideally it's written down, that you would sell a stock. And here's a quick quote from William O'Neill. Buying a stock without knowing when or why you should sell it is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off, but not how to land. Basically, there's 2 sides to every trade. There's the buying, but there's also the selling, and that's how you actually make profit over time. So here are a few sell rules based on technical trends. First of all, taking a step back, once again, the goal is to, of course, ride the long-term trend. We want to do as little as possible and just let the stock work. And we basically want to preserve the majority of profits. So if you make 200, 300, even just 100% on a stock, you want to preserve that for the most part. And definitely not give it back and even go negative on that trade, because you've had that amazing profit that you want to lock in and secure at least part of it. So here are some potential rules, and we'll go through some examples in just a second. One potential rule is to sell 1/3 of your position on a close below the 10-week moving average. This would be pretty aggressive and more for a short-term position trader, or basically a very active investor. Another rule is to sell 1/3 on a close below the prior base lows. So a base low is just basically a consolidation. So if the stock undercuts that consolidation, that could be basically a spot to also sell 1/3. Then lastly, we've got to sell 1/3 on a close below the 40-week, which is declining moving average. So this would be the longer term sell signal that basically signifies that the stock has entered a stage 4 downtrend. And that would be a point where you could sell the last remaining third. So let's give an example, because I think it's one thing to talk theoretical, but it's always good to give examples as well. This is a chart of Teladoc. I'm sure many of you are familiar with this name. We had a beautiful move over the past few years. This started from an IPO primary base, which I'll talk about later on. Beautiful move. You also had a buy point right here from a consolidation. We had another stage 2 uptrend. And then you can see that the momentum kind of changed here, and we undercut this moving average and start trending below the longer term moving average. But the key thing here is that from this buy point, we had a 1,400% gain, and you definitely don't want to let that go to zero. And right now we're flirting with returning all the way back to this prior buy point. So how do we preserve that gain? And here's just another slide showing that right now from this buy point, after a 1,400% profit, we're basically down 91% from the highs, and we've only got a gain of 27%, which at least is still green, but it's definitely not 1,400%. Okay, so here's basically the 3 sell rules that I talked about. Just zoomed in here. So this kind of shows the recent action of Teladoc. This is the most recent buy point that you could have entered at. You've got a nice move up from 200 to about looks like 305 or so. This is the first undercut of that 10-week moving average. Then we've got undercut this is the first week where the 40-week moving average is declining. So this is your second sell signal. And then lastly, we've got an undercut of this prior consolidation. You can draw a horizontal line from this point, and you can see we close below that. And this, you might feel bad because it's so far off highs. And if you bought it in here, you're at a loss. But if you bought it here, you're still preserving part of that profit. If you bought it all the way at its IPO, you're preserving a lot of that profit. And it might feel bad in the moment, but the stock continued down 80% from this last sell signal. So you're preserving a lot of profits and making sure that goes in your pocket. So this is something that I see pretty often on Twitter, especially with investors. This type of selling only happens once in a decade. The stock will come back eventually. We just have to wait and see. This could be true, but also it happens a lot more than I think a lot of people realize. During every major correction in the stock market, which happens pretty regularly every few years, we see stocks that were former leaders, go through stage 4 downtrends, and some may come back. That's the exception. Some may kind of, underperform the market for a few years, but some will just continue down and, really get back a lot of profits that they made during the previous few years. So here's an example from Baba. And I saw a lot of people posting here, that it's undervalued. It's a must buy. It's going to go back to all-time highs. And yet it remains in a stage 4 downtrend below declining 10 and 40-week moving average, and has gone all the way from around 300 at its peak down to looks like around 81. I can't quite read the screenshot here, but regardless, it's given back an extreme amount of profits that it made during the previous few years when it was a fantastic stock in a stage 2 uptrend. But the momentum shifted. So every person who tried to buy the dip, oh, it's moving up, I'll buy it here. They just are basically underwater and not respecting that longer term weekly trend. Here's Boeing, another similar stock that was fantastic, a market leader. It's had many amazing runs during its lifetime. Here we've got another great stage 2 uptrend. You can see how price respects that 10-week moving average, and we're just riding that high to higher prices. The 40-week is in a strong uptrend. Then this is a classic kind of stage 3 consolidation where a price gets a little bit choppier. It goes above and below these different moving averages. And then in 2020, obviously there was the catalyst here, but we were pretty weak even before that catalyst. We start a stage 4 downtrend and really give back all these years of profits all the way back from 2017 to 2018. And just in a short period of time, we're giving all that back and then some. And even now we're still in a stage 4 downtrend, and it's just not a healthy stock. It's wider and looser, and there's no sign of a distinct strong uptrend like this where the stock is under accumulation. And right now it's just a wait and see stock that's not doing much. So we have to respect these longer term trends. We can ride them and produce some amazing profits. But when that stock enters stage 3 and definitely stage 4, we want to be a little bit more cautious because no one knows how far these can fall. Here's another example, GE, going back to another kind of blue chip name that was part of everybody's 401k and one of the biggest stocks in the world. We have a beautiful stage 2 uptrend in the 90s. Then in the 2000 bear market, we begin a stage 4 downtrend that lasts for multiple years. We get a slight uptrend here. It underperforms the market a little bit. And then once again in 2008, we get absolutely slammed, stage 4 downtrend, and we give back all these decades of profits. And if you entered in here or dollar cost averaging in here, and you're feeling good, you've got a great profit, then you give it all the way back and then some. So we got to respect these stage 4 downtrends, even in a stock that's supposed to be, a sure thing, a blue chip name, a FANG stock. This is basically the equivalent of a FANG stock. So we have to respect those longer term trends. And even now we're doing pretty much nothing, actually in a stage 4 downtrend again as of this moment. And we had another one here, looks like in around 2018. Here's Netflix, a current name that has gone through a stage 4 downtrend. We're maybe forming a stage 1 base here or a late stage 4 here. But this is a stock that's been a fantastic performer. And it's actually had many times where we've had a stage 2 uptrend and then given a lot of it back in a stage 4, and then continue to innovate as a company, produce more fantastic content, start streaming, create new shows. And that innovation has led it to recover, for the fundamentals to improve, and for the price to move and restart a stage 2 uptrend. But still during these stage 4s, we've gone down 60, 70, 80%. And this time is no different. And we just have to wait for that next uptrend and for the market to agree that Netflix is still a good company. And we'll just have to remain to be seen. It remains to be seen, basically, if that will happen once again. Here's Microsoft, another great performer in the 90s. Then it starts a stage 4 downtrend. And this is another risk of former amazing stocks after they go through stage 4 downtrends, because even if they do recover and kind of stabilize, they can underperform for decades. And in this case, I think it was 16 years before, approaching new highs and starting another significant stage 2 uptrend. So, Square did this a few years ago, had a really nice move, I believe, into the 2018 correction, but then it went stagnant for a few years until 2020 when it took off again. So even if a stock appears to have stabilized and recovered, it doesn't mean it's just going to go back to all-time highs and continue its dominance back here, because something has changed and it's no longer under significant accumulation. So kind of opportunity cost is another thing to consider with the stock in a stage 4 downtrend. Could that money be put into a younger, more innovative company that's in a stage 2 uptrend rather than just in a stagnant company that's a little bit more mature and has to have more innovation for actually something to occur with the stock chart? So I think this is a big question for investors. If you sell a stock during a stage 4, when would you consider buying it back? And that's definitely a fair question. So here are a few buy rules based on technical trends. First of all, the goal is to ride the long-term trend as it gains momentum. So get on a little bit early, but after the stock has actually started a stage 2 uptrend, you want to get in as early as possible, because at that point, the reward is maximized. And like with the overall goal of investing, so have as little action as possible. So we basically want to enter once and just let the trend do its work. So here are some potential rules. Once again, this rule is the more aggressive one. You can buy 1/3 of your position on a close above a rising 10-week after stock is in a stage 1. Then you can buy 1/3 on a close above that key resistance level, which is basically the top of the consolidation period. And then you can buy your last 1/3 on a close above a rising 40-week moving average. So pretty much the converse of when a stock is entering a stage 4 and we want to sell. Here, the stock is entering a stage 2 and we want to basically accumulate and buy. So here's a graphical representation of this ideal buy point. Here at point A, we're moving above the consolidation in stage one. And then here's a retest point B, but you don't really have to worry about that. And this is the start of the stage two uptrend. This is when we want to be really accumulating just after the stock starts moving up in stage two. And here we've got, of course, the stage four, where we're below a declining longer term moving average. Stage one, price starts trending sideways, gets back above the moving average. And then here is the stage two, which is when we really want to start aggressively putting on our position. Here are some more examples, because I think it's so important to look at, real examples that illustrate this fact. This is Tesla back in 2019 here. This is 2020. We had an earnings gap up here, which started the stage two breakout. You can see we begin trending above a rising 10 and 40-week moving average. This was a super powerful trend. Then, of course, the COVID correction hit. We corrected all the way down to the 40-week, undercutting that 10-week moving average, but then ultimately do recover and start another stage two uptrend as price trends above a rising 10 and 40-week moving average. And of course, we all know that Tesla was one of the basically best performers that year. So these stage two uptrends can be extremely powerful, and they often start with an earnings gap up. So that's a key thing to look out for as well. SQ, I mentioned this earlier. This is when it was basically doing nothing, going sideways below this key level, which is around 83, it looks like. Then in 2020, we finally break out into new all-time highs and start a really nice trend above a rising 10 and 40-week moving average in that stage two. Twilio, this is another IPO primary base setup, which we'll cover in just a second. This is when it IPO'd, it had a nice move, then went through a longer term basing period where it basically goes sideways. And then once again, this is an earnings gap up here. It breaks out through this key level, which was resistance, and starts a nice trend above a rising 10 and 40-week moving average. And we all know that Twilio has been one of the best performers over the past few years, and it all started from this move, from this setup. So with that said, let's cover a little bit more in depth into that IPO primary base setup, because I think it's a great thing for investors to learn. Just checking the time here. It looks like I'm pretty good. So this is a setup that occurs over and over in the market, where a stock that's promising, it's innovative, comes public. There's a lot of initial hype. But then some selling hits and the stock basically consolidates and goes nowhere for 6 months, 9 months, even multiple years before it actually starts a significant move. Often this coincides with when the 40-week moving average starts appearing. So I like to use this moving average as kind of indicator that the stock could be a little bit ready to start a move that could last multiple years. So keep an eye out for when this 40-week moving average starts appearing on charts. But this takes a little bit longer. We consolidate here. We've got a breakout through 17 on increasing volume, and this starts a really nice move. And this is Palo Alto Networks, PANW, which has been a fantastic stock. And this is a nice initial stage two breakout, moving above a rising 10-week, and the 40-week basically starts moving up shortly after this point. So here's some more definitions here. Basically, this occurs after stock has gone through its first major consolidation. This is another example with CrowdStrike back in 2020. We get the IPO, initial hype, then longer term basing period, breakout through a key resistance level, and this starts a nice trend above a rising 10 and 40-week moving average, a nice stage two. And this can be a great time to invest in a promising growth company. And I want to shout out the Lifecycle Trade, Eve, Kathy, Eric, and Kurt. They wrote a great book called The Lifecycle Trade, which really goes into depth about this setup, which I highly recommend everybody check out who's watching this. And even if you're an investor, it's a great read. Basically, they studied all the IPOs going back, I think, 3 decades, and they give statistics about what happened when a stock started this move, what happened to the best performing stocks, how can we find the next ones and enter early those names. And they give a ton of statistics, and it's definitely a great book. And there's even more kind of buy and sell rules if you're interested in that. So definitely go ahead and check that out. So here are some examples. We've got SE, which was super popular in 2020 because it had a fantastic move. But really, this whole uptrend started with a breakout on huge volume from its IPO base consolidation. This started a nice stage 2 uptrend, which paused here during the COVID correction and then restarted. And now we're just in a stage 4 downtrend. So you can see we started that stage 4 all the way up here, and now we've fallen from about 270 down to looks like the 50s here. So it's giving back a significant portion of those 2020 gains. So if you can learn to recognize this shift from a strong uptrend to a strong downtrend that can help you preserve a lot of your capital. And everybody who tried to buy the dip, dollar cost average in here has given back a lot of capital. And you can see volume increase a lot as well, indicating more distribution. TTD, another great performer over the recent years. IPO-based breakout right here. Nice initial move. It consolidates a little bit more. Breaks out again. This was another earnings gap, so that's another key thing to look out for. Starts a stage 2 uptrend, and once again, this has been a great performer. And pay attention to these huge breakouts on volume because often they can be the start of major moves. Tesla, I already went through the kind of 2019, 2020 period, but this is actually just a few years after its IPO. You can see we have initial hype and even more initial hype. Then it basically goes stagnant from 2011 to 2013 before it finally breaks through this horizontal level on huge volume. We've got a gap up here, and it goes on a super strong run from about, obviously this is post-split, so 2.6 to about 17 in just a very short amount of time. And this is basically the type of move that you can get from those IPO based breakouts. Coop, another recent example. We had initial breakout here that fails. It basically bases again, but then we start a nice stage 2 uptrend, which respects that 40-week moving average, and we go on and increase nicely from that point. Here we've got Netflix, which also had a similar IPO-based breakout, beautiful stage 2 uptrend, and you can see we trend nicely above the rising 10, and it respects that 40-week moving average pretty much for the majority of the move. And from this point, we correct, I believe, about 60-70% from this initial move, giving almost all of it back before, of course, the company innovates and comes out with streaming, I believe, and restarts that stage 2 uptrend. Zoom, another popular stock. You can see that the 40-week moving average appeared right here. That's a hint to start watching a stock. Then we get a breakout through this horizontal level on an increase in volume, start a trend above a rising 10 and 40-week moving average, and then ultimately roll over and start a stage 4 downtrend, giving back a lot of these 2020 gains. Crocs, going back in history, we've got another IPO-based breakout through this important level. Nice move, a nice trend above a rising 10 and 40-week moving average. Then this was actually an earnings gap down here on enormous volume, and this started a correction of I believe, about 70-80%. So once you get a huge sell signal like this and a break of the 10-week, you definitely want to be on your guard because you can give back a lot of these profits. MasterCard, going back again, IPO-based breakout, beautiful trend above the moving averages. Then once again, we break and start a stage 4 downtrend and give back a lot of those profits. SQ, I mentioned this previously, but this is its first move back in 2017. We have a consolidation period. Then it finally starts breaking out, starts rising above the 10-week and 40-week moving average. Beautiful trend, nice respect for that 10-week moving average, and ultimately roll over. And we don't die completely and give all this back, but we do basically go sideways for the next few years before, obviously, that 2020 run. So that's pretty much it. I think I'm pretty good on time. Basically, in terms of a recap, hopefully I've introduced you to reading charts and what to look for on a weekly time frame. Hopefully you can determine a little bit those 4 different stages where we've got a stage 1 where we're basically consolidating, a stage 2, which is a strong uptrend, stage 3, once again, we've kind of peaked, at least in the short term, and are basically going back and forth, consolidating, and then stage 4, of course, we've got the decline. Hopefully, if you have never used charts before, I've challenged your thinking a little bit about how useful they can be. And hopefully I've also suggested a few rules based on technical analysis that you can kind of take, make your own, and hopefully protect all those different profits. And the IPO primary base setup, I hope at least that was interesting to you because I think it's so repeatable and happens every year where IPOs come public. There's that initial hype, then we consolidate, and then that can basically start a huge move later on down the road. So that's pretty much it for my presentation. And here's the final quiz. What stage is the stock in? I definitely want to see some answers here in the chat. You can see where price is relative to, looks like this 10-week is declining and the 40-week is declining. So those are 2 big hints. So what stage is the stock in? I'm waiting for at least one presentation. I think we're a little bit delayed here, but interesting to see what you guys think. And also, if you want to give your guess about what stock this is, that would be interesting as well. Stage 4. Okay, awesome. Awesome. A lot of stage fours. Perfect. So this is actually, oh, I got to go back over here. This is actually skills, and this was showing it right here. And then we dropped, from 11 down to $1. So definitely a stage four downtrend. And you can just see how devastating this can be. Obviously, this last year has been, a little bit extreme because we had such powerful moves. But nevertheless, when a stock is in a stage four downtrend, you definitely want to respect that. So that's pretty much it for my presentation. Thank you guys so much for your time. Hopefully you learned something, and I'm happy to take any questions whatsoever. And if you have any questions or want to learn more about the strategy, I highly recommend the stage analysis masterclass that we did with Stan Weinstein himself over at Traderline. And feel free to email me if you have any questions about that. And with that, happy to take any questions.
Richard, that was awesome. I'm just grinning because the Q&A, I don't think you can see it, but the Q&A is just filling up with so many questions, and I love to see the interest from everybody. So I do think that technical analysis is somewhat of a new concept to a lot of people. And I think it would surprise people to know that, someone like me that's very fundamentally oriented, technical analysis is a core part of my process. I think about it as just another part of the mosaic for me to either buy or sell something. But let's get to the Q&A, because I think people are very interested in some additional rules, things that you look at. Sure. Maybe just starting, this one made me laugh from Rachel. Do all gaps need to be filled?
Yeah, that's a good question. I would say no. I would say a lot of them do get filled, but the gaps that don't get filled can start some major, major moves. And I actually asked Stan Weinstein, we did a Q&A just 2 weeks ago about this exact same question. And he said, basically the same thing. Not all of them get filled, but the ones that don't, you better watch out, because it's either going to start a huge uptrend if it's a gap up, or it could start a really strong downtrend if it's a gap down.
That's fascinating. So it's actually a really important thing to look for as a high probability move one way or the other.
Yeah. Just to elaborate a little bit more, a gap is basically the street getting caught off guard. And there's been studies about post earnings gap drift. I forget the acronym or whatever, but basically what happens is if a stock comes out with amazing earnings that surprises everybody's caught off guard, and institutions have to start accumulating that stock if it meets their mandate. And these institutions that really drive the market forces aren't able to start a position all in one day. So they have to slowly accumulate. And after that initial gap up, they basically create that trend because of that accumulation over weeks and months. And that's why it can really start some major moves that we can ride as kind of retail investors and traders.
No, absolutely. And I think it's a great rule also to protect you to the downside as well, because the post earnings drift happens both ways. And that's why, you see, especially this year, you've seen the Netflix of the world, Meta, etc. You had a big earnings gap down, and the stock just continued trending down. And that's why people refer to the 3-day rule, because to your point, institutions need time to get out. Or otherwise they'd have a outsized impact on the stock price. So it's actually a really, I think, interesting tool for people to use as a framework.
One of my biggest, I didn't end up taking a loss, but giving back a profits was actually Fastly in 2020, where I had a nice trade on that. But then we had that gap down. I don't even know if it was earnings or just a pre-announcement of revenue or something like that, but definitely bad news, and a gap down 20% the next day. And I basically had a full position, and I sold pretty close to the open. And, it feels bad. The stock is down 20%. I'm selling. I gave back all those profits, but it's protecting you from that stage 4 downtrend that took the stock down 90% or whatever it is. So that initial price reaction that's extremely negative is a sign that institutions have changed their mind about the stock and that the trend has changed. So I think it's super important to key in on both gap ups and gap downs, because like I said, either way, they can start really big moves that either you want to be a part of or you want to step aside and look for another opportunity.
Yeah, it's amazing for me to look back to on some of the stocks that I've sold and when I sold them and how terrible it felt at the time. Yeah. And it ended up, and they're like 50% lower now. Because to your point, it's almost like a snowball effect as they move lower. We're getting a few questions here on the IPO basis, which, I know Mike Webster has done a lot of work on. That's how I first learned about it. I think the main question that some people are asking about is, why 40 weeks long? It is kind of the big question that I'm seeing here. And one quick comment that I'll make too on the 40-week period is that it's roughly 200 days. And what's interesting about the 40-week time period on the technical side, on the fundamental side, usually 180 days is the lockup period, which is when kind of people hold out for. So yeah, I think people are interested in why 40 weeks. Like, what's so important about that?
Yeah. So it's awesome that people are really interested in it because I think it is something that appears over and over, and investors can really make use of it. Um, the 40-week kind of trick where when the 40-week shows up, it's time to start paying attention. It lines up nicely with what you just said. But I actually learned that from Kathy Donnelly. I've done a few interviews with her. She's the author of The Life Cycle Trade. If you're interested in the setup, you have to go out and buy that book. I think it's like $20, and they basically did a huge study of all the IPOs. You have to read it, basically, some great statistics. But they call it basically the institutional due diligence zone, that primary base where the stock is going sideways. And that's basically time for institutions to do their research and determine whether the stock is worth investing in after it's come IPO'd and had a few quarters of earnings that they can analyze. So that time is basically that basing period. And then finally, if they decide, if enough of them decide that it's worth investing, that's what can start that major moves, because the major moves in the stock market occur because of the biggest institutions, the biggest hedge funds, the biggest pension funds building positions, because they move around, billions and billions of dollars. And that's what ultimately causes those moves. So I forget what the initial question was, but I think it was why that 40 weeks. So basically that was a trick that Kathy Donnelly, who's, she's a trader, but she's actually got a very long time frame, basically investing almost. And that 40-week is super key for her. And that's just a trick that she said she really looks for when that 200-day moving average, which is the 40-week moving average on a week on a daily chart, starts showing up. That's when she starts getting really interested in and starts looking for those breakouts and opportunities to scale in, and basically signs that institutions have started accumulating positions.
Awesome. There's no way I'm going to get through all the questions. So just kind of a heads up for everybody. You're going to have to probably email Richard or ask him through Twitter.
Yeah, Twitter's good.
I'm going to get through as many as I can. So this is a question on the moving averages. So why 10 and 40 weeks? And then other than moving averages, what other parameters do you focus on?
Yeah, really good question. So the 10 and 40 week are useful for different time frames. So I get a question a ton. I get this question so many times, and I actually mostly use shorter term daily moving averages. And people are always like, why do you use this specific number of moving averages? A 10, a 40, a 21, whatever. The key thing is that you want to use a moving average that is useful for your time frame in order to determine the trend over that time frame. So a 10-week moving average is a nice intermediate amount of weeks, basically, that is able to determine what is the trend over 10 weeks, 50 days, what have you. So if that's your time frame, that's a useful moving average to basically use as a reference point. The 40-week is more for longer term investors who really want to ride a stock for, a year plus, and not focus on those daily fluctuations or even weekly fluctuations, just focus on that longer term trend. And that's why that 40-week moving average came about. And I'm using the 10-week because, a lot of people use it as well. I'm schooled in Can Slim from William O'Neill. He likes the 10 and 40-week moving average. But the specific number isn't really the important thing. It's about what is that overall trend and how is price acting overall. You could use an 11, you can use a 12. They're going to give very similar signals. So just pick one that works for you and works for your time frame, I think is the best answer I can give.
Yeah. It's interesting because I think that it's gotten somewhat like reflexive. There's so many people that kind of watch them that it almost makes itself work, if you will. And you and I were talking backstage beforehand about how ominous it now looks with the Russell and the S&P running up to the downward trending 200-day moving average, and that's where it got rejected. And I think it's because so many people are looking at that level, and that's what they use to then sell out. So I think that's the right point. It has to match your time frame, and it's more about the overall trend rather than just like what the exact number of weeks are.
Exactly. I do think they're probably coded into a few algorithms. I've made my own few programs that determine trend, and they're just a good time frame. So, but yeah, everybody uses them. So that's another reason to be looking at them, because, if a lot of people are making decisions based on that 50-day moving average, 10-week, you should probably be looking at that as well.
Yeah. You mentioned, so Jorge asks, you mentioned EPS growth. You mentioned Can Slim, which of course I'm very familiar in as well. He asks, do you look at company fundamentals or 100% technicals?
Yeah, great question. I look at both. I consider myself a techno fundamentalist, which is a fancy word that just says I combine technicals with fundamentals. Can Slim, which is kind of what I grew up on, started learning first. We're basically looking for the fastest growing innovative companies that are changing the way we work, live, and play, that are growing super fast in terms of earnings growth, sales growth, coming up with new products that are changing the world. But whatever I think about that company, if I think it's amazing, I won't buy it unless the chart says it's under accumulation and it's also a low risk, potential high reward spot to enter. So I'm using those fundamentals to help guide what I'm looking at, but then I ultimately manage my position and trade my position because of the chart. So that's kind of the best thing I could say. And I have kind of shifted slowly more over to more technicals over the years, but I still pay attention to what is the theme going on, what are the new products, what's driving this move, and what could drive a major move. Because the best stocks in the world, going back in history, all had an amazing product, or amazing growth behind it. If you look at Apple, I think coming out of the 2000 bear market, I've studied that chart a lot. The actual like breakout off the bottom was on the same day that there was the announcement of iTunes, where people could buy money for buy songs for the first time online, as well as I think the new generation of iPods. So these important events can be tipping points in a company, and that's going to show up in the charts because once again, if an institution sees this amazing product and sees these growth numbers that a company is reporting, and if they're caught off guard, they're going to have to accumulate positions, and that's basically longer term trend that I want to ride. So sorry, that was a really long answer for a pretty simple concept. Basically, I look at both fundamentals and technicals.
And I think to just drive home that point too, how we're talking about combining the two. Well, you mentioned the iPod release or a product release. That's something that we would refer as, in at least my job, and I think a lot of the more fundamental buy side analysts as a catalyst path. And so you want to understand like where are those inflection points that could change the narrative of the stock, and the follow through of the fundamentals. So it all comes together. It just is kind of a difference of where you're looking for that information, which is really interesting.
Yeah.
The next question here from Ravi is, for a new stage one, would you look at indexes first turning up and then individual stocks, or simply focus on individual stocks getting above moving averages mentioned here? And I have a lot to say on the topic, but of course, Richard, I'd love to hear what you have to say.
Yeah, another really good question. So obviously, we're in a bear market right now. The indexes are in stage 4, but there are still stocks that are kind of fighting that overall downtrend. And even though the market is so negative, they're maybe in stage 2 uptrends or just starting stage 2 uptrends coming off the lows. So I'm looking at those stocks first. I'm trying to find the next Apple, the next Google, that is under accumulation, even though the market is so negative and institutions have such a negative view of the overall market. So if you can find those leaders early, once the market kind of turns around and the currents are with the stock, the wind is at your back, those stocks that are fighting the trend are showing relative strength and could be about to take off once that market pressure, that overall market pressure lessens. So I guess the answer, it'd be stocks first, but also the biggest moves in stocks coincide with big moves in the market. If the market's going to move up 10%, 20%, the best names are going to move up multiples of that. So 30%, 50%, 100%, 200%. So if you get the best scenario is going to come out of this bear market where the stocks that have had, companies that are coming out with huge new innovations that are growing super fast, earnings acceleration, and they're fighting the trend. Once that market pressure lessens, the market has been stretched so thin that we're going to have a huge rally, eventually a new bull market, and the best stocks are going to go up 300, 400, 500%. And it's going to be brought upon by those innovations, by that earnings growth, sales growth. But right now, everything is getting kind of pulled back by the market. So I look at both, but stocks first, to answer it in one sentence.
I love it. And it's something that, I think you and I have talked about a lot, and I've talked about a lot with other guys that do follow Can Slim, other technicals, is that usually what you see when a bull market's about to resume is the leaders are actually breaking out first. Yep. And so what they're doing is they're using the time period of the consolidation in the market to consolidate themselves, and they'll usually break out before we really see the indexes kind of follow through, which I think really supports the point that you're making.
Yeah, look at a chart of Zoom in 2020. I mean, it was moving off its lows and making new all-time highs when the market was just coming off its bottom, and that's what I'm looking for. If a stock can be at all-time highs when we're in a bad correction or bear market, you got to put that on your watch list, do more research, and if there's a good buy point and everything checks out when the market turns around, that should be your focus. That right there, that could be a big winner.
Yeah. And another thing too is like the number of stocks that are kind of setting up that way too, right? I think it's
Yeah,
something that a lot of that people, of course, that follow the technicals look at in terms of market strength. Fundamentalists, even I would say technicalists refer to it as breadth, but I think it's like that leadership list is kind of a big indicator of, okay, maybe this is the time. What's interesting is that when we had this past vicious rally, we went up like 17%. We had
yeah.
retraced half move lower. There are very few stocks, individual stocks, that were looking ready to move higher. And that was almost something that a lot of people I saw reference that was like, this probably is not the move higher.
Yeah, pretty much in the recent rally, the solar stocks were acting well, and biotech and healthcare related stocks were acting well. But yeah, for a strong bull market, you want too many stocks that you want so many stocks that you can't possibly buy them all, and that's going to be when the market turns around. That's what you're going to see. You're going to see so many setups, so many stocks breaking into an all-time highs. And right now, if you look at the net new high, new lows, that indicator, just new lows, new lows, new lows every single day. So that trend, that change hasn't really happened yet. So definitely waiting on that, but I'm looking forward to it because there's going to be some really amazing opportunities coming out of this.
I love it. It's a good heuristic.
Yeah.
The next question here is, do you still meet people who don't believe in technical analysis? And then in parentheses, they may not use it, but do they still think it's hogwash? ? And I would add to that, what do you say to those people?
I definitely still see it on Twitter. A lot of the people who I follow are trading similar to me, so I don't interact too much with people like that. I think there's a time and place for dollar cost averaging, especially if that fits your lifestyle better. And to dollar cost average, you don't need to look at charts and try to find the perfect opportunity. You might be giving up some performance potentially, but if it fits your lifestyle, no matter what, you should be investing and involved in some way. So it doesn't matter if you're trading or investing, you should be involved in some way. I kind of view it as, a little bit like calculus. Not everybody can do calculus, but that doesn't mean it's hogwash or it doesn't work. If you can't take a derivative, you can't take a derivative, but that doesn't mean that it's not real. So there's definitely people who are much, much better at it and can do differential equations. There's some people who are still working on addition and multiplication. So focus on your strengths and focus on that, and then move on to adding more tools, more edges, all that. And that should serve you well.
And that's actually a perfect lead into our final closing question. But I actually wanted to quickly ask for everybody here, what are some of the resources that you'd recommend to beginners to technical analysis to start getting up to speed, maybe incorporating it into their process?
Yeah, that's a really good question. I would say the book I mentioned by Stan Weinstein, which is Secrets for Profiting in Bull and Bear Markets. I've got it. It's a little bit blurry, but I've got it a copy right there on my shelf. That's a great book to focus on the technicals and focus more on the stage analysis, which I talked about here in this presentation. Also, William O'Neill, the founder of CanSlim, How to Make Money in Stocks. That's excellent. A favorite of mine, my favorite book, which isn't so much going to teach you so much the technicals, but he kind of learns it as you go, is How I Made $2 Million in the Stock Market by Nicholas Darvis, traded during the 60s and maybe the early 70s, or maybe it's 50s and 60s. But regardless, he basically made every mistake in the book. And it's basically his story of finding his path, where he started out following tips. Then he tried incorporating some fundamental analysis. That didn't work for him. He lost a lot of money. He started buying just because of technicals. That worked pretty well. But in the end, he is kind of the original technical fundamentalist because he's looking for exactly what I said, the fastest growing companies, but with charts that are super strong and great uptrends breaking out of bases. So yeah, I think that book is excellent. Mark Minervini's books are extremely good, great historical examples. If you're looking to learn specific rules, those are fantastic. And then lastly, I already mentioned it, but the life cycle trade is fantastic as well. And I'll tweet out on Twitter. I've got a whole 20 book list of recommended books. So I'll tweet that out again today. There's my Twitter at richardlmoglen. And if you have any questions whatsoever, tweet at me. I'm pretty active on there. I'm on there too much. Seifel, you're on there too little. I'm on there too much. So definitely ask me any questions you've got. And those are some great books to get started with.
Yeah, that's awesome. I've read a few of those, and I would highly recommend them as well, along with Reminiscences of a Stock Operator. It's one of my favorites as well.
Yep.
And so, Richard, our last and closing question here is, what one piece of advice would you give to retail individual investors?
I would say treat everything you're doing as, well, treat your approach to the stock market as a student. And what I mean like that is, don't get too hung up on mistakes or even on successes, because there's always something you can take away and learn from it. I'm learning every single day. I'm relatively new to this, but I've gotten the pleasure to talk to so many experienced traders and investors and learn so much from them. But there's always something that you can do to improve. This goes beyond the stock market. I'm not going to get too life coachy, but always think about what you can do better. Look back on your best performing trades or investments and try to find common themes between those and try to do that more. That's pretty simple. But also, and I know this hurts and it's embarrassing and you don't want to do it, look back at your worst trades, at your worst investments, and think about the shared commonalities between there. Did I not place a stop loss? Did I enter in a stage 4 downtrend? Hint. Probably a lot of you guys may have done that recently this year. Did I not follow my rules? That's a big one. Did I enter extended? Look at the commonalities in your worst trades and your best trades. Do more of what's working and do less of what's not working. And, over time, just try to get better and better and better. I recently read Atomic Habits, which you can probably hear in my voice, in my explanation. Just try to get 1% better over time. And, that's going to contribute to really great performance over the long run, whatever your process is. If you're technical focused or fundamental focused, there's always something that you can learn and do better at.
I love it. Well, Richard, thanks so much. The talk was awesome. I learned something, as I always do, from you. I hope everyone else did as well, and maybe got inspired to look more into technical analysis. I think it's a really helpful tool at the minimum. Thanks again to Titan and ARK for sponsoring this session. We will see you all in about 15 minutes for our last session of the day. Richard, thanks again so much. Really appreciate it.
Yeah, thanks for having me. You guys are doing a great job. And I hope people learned something and weren't too offended about my views on fundamental analysis only. So hopefully you guys picked up something new.
Excellent. Thank you.